Hello, everyone, and thanks for taking the time to listen to Alternative Angles, a podcast series where our guests represent a wide range of expertise across the entire alternative investments landscape. I'm Chris Pariseault, head of institutional portfolio managers at Fidelity Investments, and your host for Alternative Angles. In each episode of this podcast series, we'll get to know the people who make investment decisions in highly complex alternative investment strategies, but strategies that are becoming increasingly vital components to well-diversified multi-asset portfolios. The goal of Alternative Angles is simple. These seasoned investment professionals have all earned their stripes in their highly nuanced markets as investment managers and institutional investors. Their knowledge and savvy are extremely valuable, and we want to share their perspectives with you. For the first episode of Alternative Angles, our topic is direct lending, and our guests are David Gaito, head of direct lending for Fidelity Investments, and Ariel Goldblatt, partner at StepStone Group, overseeing global private debt co-investments. After having spent my entire career in fixed income, I am especially excited for this episode. Thank you both very much for taking the time to be here. Before we get started, I'd just like to level set for a moment on what the direct lending market is. Direct lending is a subset of the corporate private debt market, which includes direct lending, mezzanine debt, opportunistic distressed credit, and specialty finance. So private debt is also referred to as private credit, and that entire market is about 1.8 trillion in size and has grown to be as large as the high yield and leveraged loan markets. Direct lending represents the lion's share of those assets today at 1.2 trillion. Direct lending is private debt issued by small and mid-sized companies who turn to private lenders because they either can't access public markets or banks or choose not to. And the coupon structure is floating rate, so there's a base rate with a spread to reflect credit risk. And they're typically senior secured loans, and covenants are negotiated directly between the lender and the borrower. And because of the private nature of these investments, they're less liquid than publicly traded loans, so investors don't have immediate access to capital that they invest with the direct lender, but there's typically a liquidity premium that compensates investors for this. Small to mid-sized borrowers have turned to the direct lending market largely as a result of increased bank regulations stemming from the GFC back in 2008. These regulations prompted a reduction of available capital for direct lending, which accelerated this banking disintermediation. We've also seen strong growth in private equity, providing a strong foundation for the private debt markets. David, I'm going to start today's discussion with you, and maybe you can tell us how you got started in middle market credit. So what's the appeal of this part of the alts market?
Well, 25 years ago, I started at PNC, at the time a regional bank, today a national bank, and I went through their traditional credit training program, which consisted of school-based training for about 6 months, and then was followed by multiple rotations throughout the bank. I did capital markets, I did large corporate, and then I landed in their middle market group, and I quickly kind of fell in love with the business because these are companies that it's one-by-one negotiation. It's helping a business, trying to structure a solution for it. The passion for the business actually grew as I met someone by the name of Bill Kosis. Bill was GE trained, actually worked under Jack Welch, and brought a very different mindset. He ran what was effectively PNC's commercial finance business. And I moved from being an underwriter to a portfolio manager to originations and leading teams, et cetera, and just had an incredible experience. There's so many different types of companies in the middle market. You touch them every day. Many unique characters that you meet, incredible managers. And then working with private equity, you kind of get the same experience. You meet a lot of folks that have different focus, different strengths, different weaknesses, and our job is to figure out which ones we like best and invest in those. The appeal for investors and I think our teams is that it's an inefficient market. When you think about a larger corporate public offering or a broadly syndicated loan, you have an investment bank that will go out to hundreds, if not thousands of people to make a market for a particular issue. In our world, an owner might go out to 2 or 3 people to provide the financing. And the reason is pretty simple. They want to know their counterparty. This is typically their, they've got a lot of equity invested. They want to make sure that their counterparty understands the business. They don't just want the cheapest and loosest structure. And then lastly, it's an all-weather asset class. If you're with a good firm, a good investor, this is an asset class that you can invest in every single year, no matter how tight the credit markets are or how dislocated they are. And so that I find those to be the reasons that this market is growing and is appealing to more and more investors.
And so when you say all weather, you mean there's really no entry and exit risk. There's a variety of loans in the portfolio across a variety of industries. And so therefore, it's not really dependent on any one market environment.
That's right. When you think about our typical coupon rate, I like to explain to investors, if you're in traditional direct lending, you should think of the return in the form of floating rate SOFR plus a spread of 5 to 7% and an OID anywhere from 1 to 3%. The band is, if you're in a really tight market, the rates get a little lower. If you're in a dislocated market, they get higher. It's very different than a distressed or opportunistic strategy where you need catalysts to deploy a lot of capital.
Right. Makes sense. Ariel, I'd ask the same question of you. How did you get started in the business, and what brought you to direct lending?
Thanks, Chris. Yeah, I mean, I started actually in the typical investment banking program. And what was unique for me is that, or maybe not so unique, is that every pitch in investment banking was about upside opportunities for PE sponsors. And what I found myself doing when I was in banking was realizing that I was actually more concerned about the downside than finding upside opportunities. And so after investment banking, I actually went to Crescent Mezzanine before the great financial crisis. And that paired well with my focus more on the downside than on the upside. And then from there, I took a little bit of a circuitous route, trying out private equity and public equity worlds. And then finally realizing that I really wanted to come back towards the debt side. So I joined StepStone about 5 years ago to run their private debt co-investment business. I continue to be amazed at the stability and the resiliency of the direct lending asset class, the strong risk-adjusted returns, how much fun it is to learn about managers and borrowers in all different industries and geographies.
So would you say that the fragmented nature of the market's appealing to you as well? So that ability to really exploit inefficiencies, it's harder to do than in most traditional markets?
Yeah, I think that's right. And what I also like is just the stability, the reliability of the asset class. As David mentioned, this is an asset class that year in, year out returns between 8 and 10%. It's consistent. I also like the fact that you're a partner to sponsors and management teams. To me, that really makes it much more interesting for my day-to-day job.
Hey,
So
Chris, can I add something?
Sure.
Sorry. When you think about how big this market is, think about the investable universe, right? There are a little more than 4,000 U.S. public companies. There are over 200,000 middle market companies. And it's just a massive universe. And if there are a lot of really good businesses that have been around for 30, 40, 50, plus years that have real moats, et cetera. So it's a really neat space. And while they're not as large as public companies, they might compete in a region with a public company. They might supply a public company, or a public company might be a customer. So it's a pretty neat universe that, we all touch and don't realize it on a day-to-day basis.
So that's a great point, David, and brings us maybe to our next question. So when it comes to alternatives, which are private markets, and as you both say, can be inefficient and fragmented, great opportunity set with over 200,000 private companies. The firms that invest in these companies, so David, you and Ariel, cultures matter a lot, right? For investment philosophy, process, hiring talent, risk-taking culture. Can you explain the investment culture at each of your shops and maybe your role in shaping it. Ariel, maybe we can start with you and StepStone Group.
Sure. I mean, the one thing that really surprised me about StepStone when I started was the entrepreneurial spirit, despite the size of the company. So for example, we have an open door policy. The ability to take on more responsibility is highly encouraged, including, a junior person can make suggestions to improve processes or add additional products that they think are missing in the market. From my perspective on culture, it's really quite important. I try to provide my colleagues, my peers, the people who work for me with the opportunity to grow. We try to give the junior team members a lot of mic time on committees. This gives them the opportunity to practice their presentation skills, think on their feet, share their observations, etc. Another example is that we really do strive to include junior team members in GP and client meetings. And during those meetings, we encourage them to speak up, ask questions. And this is part of the culture to help grow our talent bench from within and really help them succeed and move up within the organization.
So we know that across our own businesses, for example, being able to promote from within on the investment side, a massive head start when filling roles from trading analysts, portfolio managers. The junior team members already know the process, the philosophy, the culture. They're already embedded, and their history as you invest in them and they invest in you. So David, culture is important to you. Why?
Culture is everything. It's really the fabric that's woven throughout your company, your team. And when you think of great companies, you always think of great culture. And culture is something that you can't necessarily touch and feel, but if you're around it enough, you do see how tangible it is to the success of a business. And you think about our business, which ebbs and flows, right? Credit markets become looser, they become tighter, dislocated, etc. Culture is what gets you through those times and allows you to be successful. And if you don't have great culture, it's also what typically is the root cause of failure. When you think about the combination of the team we've put together in Fidelity, I didn't realize this when I said yes, but our cultures are virtually identical, right? Customers, investors come first, right? It seems kind of simple, but every investment you make, you have to think of that customer investor. Every action you do has to be with them in mind. And that's how we think here. And then the next is your brand, Fidelity, right? You know this, Chris, you've been here much longer than I have, but our brand is everything. Our brand is the trust and faith that our customers and investors put in us. And that comes before everything else. And then it's us, our team, right? And we talk a lot about an investor mindset, right? And an investor mindset, quite simply is be curious, ask questions, right? And credit, be skeptical, right? We don't have the upside of equity. So we have to focus on the downside, understanding what could go wrong. And then lastly, I think a good credit business, you're somewhat contrarian, where it's, be relevant in aggressive credit markets and then be very relevant during dislocations, because you can really build brand value during those dislocations by having discipline in the more aggressive time.
Yeah, and I would say that that's pretty much a philosophy across the board, being able to stay relevant during dislocations, being a liquidity provider. That makes a lot of sense. So you mentioned this, David. So Fidelity is new to the alternatives landscape. So we started the direct lending business in 2021, decided to hire you and build a team rather than lift a team out or acquire an existing manager, so many others have done. Why is that important, that organic growth? What are the trade-offs, maybe, as you think about it? How do you source and how will you keep good talent being so new in the business?
There's a lot of thought involved in building out this business because it's important. It's symbiotic with our leverage loan and high yield business. And I think in hindsight, one of the most important reasons is what our leadership knew, is that if we did this organically, it would be Fidelity's direct lending business, right? If we acquired someone, it would be XYZ private credit within Fidelity. You wouldn't have that same culture. You wouldn't also have the same access to the broader Fidelity platform. Everything we did in our early days was to look at how could we leverage Fidelity's scale? How could we have full access to that research team, have full access to the entire organization? How could we build out our operating capabilities and have it integrated into the company? And it's been an enormous benefit to us in every possible way. We're winning more because of how we're building it. And to me, the only downside is really time and energy. Like when you think about what acquisitions are, they're shortcuts, right? You don't want to spend the time and energy to build something. And so you buy it. We're fortunate enough to be in an organization that, thinks in decades, not days. We're private, we're well capitalized. And we have the belief that if we build something the right way, it will be a substantial business in the future. And, to date, we're proving that out. Talent to me is pretty simple, and it's the foundation of your culture. And, we hire like we invest, right? We do a ton of due diligence. We have a broad slate of candidates that we bring in. And we put them through rigorous assessments and meetings because we want to see how they perform. And we walked away from a lot of people that were really, really sharp, but just didn't have that cultural fit that we thought, was important. When you think about keeping talent, my experience has been if you hire the right people, if you treat them well, compensate them fairly. You don't have to overcompensate someone. You just have to compensate them fairly and then empower them. And that last part is where I think a lot of folks fail. Ariel, you mentioned it earlier. I mean, we invite every single member of our investment team to every committee. They're not required to, but they're encouraged because we want to have everyone there. And we encourage them all to speak up and ask questions. We're investing, our own money, pension dollars, insurance dollars, families are in our BDC. It's a very important decision for us when we invest. So we want to make sure that, everyone has a seat at the table and can ask questions. And I think if you do that, you really don't lose a lot of people over time. When you lose people, they're taking a dramatic leap, kind of like when I left PNC to come over here and build a business. They're not taking laterals.
To drill into that a minute, along the way, there is a multi-hour assessment. There's an Excel template sent out to the candidate with multiple problems on that for that candidate to solve. There's a mock presentation to see how they perform. So that sort of rigor and sort of screening, you've got the right person at the end of the day, on both sides, right? That person's investing in you, you're investing in them, and you have the right match.
I think that's right, Chris. We tell everyone in the beginning, it's not really your answers. We just want to understand how you think.
What is your investor mindset, right? Because we're hiring people that have different levels of skill, and we give them all the same assessment. And it's not, 100-page sim that they can, pick things out of. It's intentionally, sparse because we want to just see how they think.
So on the hiring process, David, I had a chance to speak to other members of the team, and here's some of the quotes I'll give you from those conversations. We implore all of our colleagues to not only have an investor's mindset, but an owner's mindset. And the question gets asked, would you put your own money in this deal? And I'll make you blush a little, David. David doesn't sit in an office. He sits right in the middle of the floor, and he and Therese Ickes and Jeff Scott, who are members of your leadership team, have an open door policy. So that flow of information is always there. They're always accessible. And I've heard them also use the word family. I've also heard that 360-degree reviews are encouraged. So looking at all of these factors, trust, candor, challenging opinions and beliefs backed by facts and data committee meetings. So this is aspirational for any investment team that's got a lot of longevity, let alone one that was just formed over the last couple of years. I've also heard that you've said no to more than a dozen candidates for a particular role before you found the right fit. So I'm assuming that all of these things are the ingredients on how you get there.
They are. My 360 review is coming up, so I'm a little nervous, not blushing.
So Ariel, as an institutional investor, how do you select managers? Price, terms, performance, people, philosophy, process. Are these all equally important to you and StepStone, or do you emphasize one or two, and why?
Yes, I'll break it down a little bit. In general, we use a holistic framework, and when we're trying to assess a manager, an investment opportunity, we try to do that through that holistic lens. And so, what we're aiming really to do is find managers and opportunities that we believe are best in class for that particular niche or segment. And really, how we do that is actually a combination of both, qualitative and quantitative analyses. On those points, the qualitative factors include things like who's the team, how experienced are they, how well resourced are they, what does the sourcing engine look like, what's their edge, and then our quantitative analysis includes our proprietary track record analysis, which basically captures over 100 data points on every single deal that manager has done at the tranche level. So it's extremely granular, and it usually includes more than 10,000 data points. So for those who have actually done that in the audience, they can attest to the pain they went through to fill out our track record.
So you're able to track data on individual deals like debt service coverage ratios, amendments, and so forth. You can see obviously not only the IRR of the manager, but a history of performance at the deal level.
Correct. So, like as I said, we typically get over 100 data points on a single loan by the tranche. So that enables us to better understand a GP's true strengths and weaknesses. So, just if I use an overly simplistic example, through our track record of review and analysis, we may find that whenever GPA does a deal that's over 5 times levered, their loss rate increases materially. So, as a result, if we're going to do an investment, an SMA with that GP, we will likely have investment guidelines in place that restrict deal flow above that 5 times mark. And so also if you think about just other considerations when we think about how we're choosing GPs to invest in, the last obvious thing I would highlight is that when you're looking at a GP, it's not just about looking at the numbers, how high their returns are, et cetera. If it was that easy, you could just look up the top decile or quartile GPs and just call it a day. But obviously returns are important, but there's always other considerations. A lot of the things that David's talked about, for example, diversification from a portfolio construction standpoint, capital efficiency, co-invest capacity, potential strategic capabilities, deployment ability, et cetera, et cetera. So there's just a lot more factors that go into it than just what are your returns.
Have you had challenging partners who didn't meet expectations, or is your due diligence process rigorous enough where you've been able to mitigate those challenges for the most part?
I'd love to say that we're perfect, Chris, but mistakes happen. Certainly not immune to them, and we always try to learn from them. I think what's unique about our investing platform is that we have set it up in such a way that we are protected in the event that a GP experiences style drift, can't deploy, underperforms our expectations. And how we've done that is we basically, for every single one of our SMAs, we have a soft commitment versus a hard commitment. And so what that means is that if we find that our GP partner experiences style drift, isn't able to deploy or underperforms, we can actually pause our allocations. So that's quite unique. It means that if we make a mistake, we can actually turn off the tap pretty quickly, which I think is important. And then just the last thing I would say in terms of as we think about manager selection is that, I wish I could say there was one single factor that is most important to us. You know, but what's really, sometimes hard to understand is that, different clients have different needs, which goes back to the point about having to be more holistic. Ideally, a manager excels in every single aspect, performance, people, strategy, deployment, et cetera. And obviously, those tend to be the ones that we deem as top picks because, they end up being top picks. But, there is no one size fits all for all clients.
Hey, Ariel, can I ask you a question? Because I'm just curious from your perspective, and sorry to take the mic, Chris, but the one thing that I get asked a lot is to compare us versus other direct lenders. And what I find amazing is how bespoke, this asset class is. Can you talk about like when you're looking at different managers, how you kind of dig through that?
Yeah, I mean, look, I think that it's a completely fair question, right? There's a large universe of direct lenders, and we do market mapping, understanding where you fit in the market, just like, where Fidelity fits, et cetera. And, and then, we really try to better understand those managers in terms of, a lot of the things we've talked about, their strategy, their team, what's their culture, how do they deploy, how do they source, what happens when things go wrong. And so, I think we really try to peel back the onion as much as possible. We spend a lot of time with our GPs due diligencing them. We are looking for more of a partnership approach, as Chris, mentioned earlier. And so there is a lot of back and forth. And so in this industry where, typically, as we said, you're generating 8 to 10% returns, we're really trying to find those managers that really stand out, not just on a performance standpoint, but have other pieces that also fit, whether it's, really great deployment, or a fantastic culture, et cetera.
Ariel, I've had a chance to speak with some folks who've worked on deals with you, so I'll try to make you blush a little bit too. Ariel and the StepStone team have a similar culture to ours, which makes working with them very easy. The alignment of objectives, let's dig in and work together. Ariel and the team are extremely helpful, giving guidance to us as a partner. And one of the better ones, an extension of our team and culture. So certainly a validation of everything that you just said. David, moving back to you again, when you came here in 2021, you based your philosophy and process on the private equity sponsor-backed core and lower middle market segments of the direct lending market, which are companies that have EBITDA up 75 million and lower. Why that particular niche?
Well, there are a couple reasons. Fundamentally, the team I put together and I have spent our entire careers in this marketplace. So you really want to invest in what you know, and we try to do that. Second, Fidelity is already a large investor in the upper mid market, right? We've got 30 billion in leveraged loans and over 50 billion in high yield. The majority of that goes to the upper mid market. So when I was looking at the business, to me, it felt natural given our capital base, where our capital base was likely to be, to complement what Fidelity was already very good at. Second, we talked about it earlier. I believe the lower and core mid-market especially is where you can perennially generate alpha because of the inefficiencies in the marketplace. When you look at, as you scale down from upper to core to lower, the firm that's buying the business cares exponentially more about who the partner is. If it's a one, bank relationship, which we have, right, many of, they really want to know who you are. How will you behave during challenges if we're supporting the business and doing the right things. Unlike as you scale up, it becomes a lot more like the broadly syndicated loan market, where pricing and structures start to blend a bit and matter somewhat more than the ultimate provider. I think that's important for investors, right? I think it's a market that doesn't have a real competitor, right? Banks have largely gone away from this market. When we're competing with a bank, it's a very low levered deal. It's likely a low multiple deal too, which is less attractive to us from an enterprise value perspective.
So for Fidelity, then, when you think about deal flow, Fidelity is in a good spot with private equity firms because you've got direct lending at lower middle market, core middle market, high yield, leveraged loans, eventually late stage venture, then IPO. So you can basically see a deal at Fidelity through the entire life cycle. And there's a lot of value in that, obviously.
I think so. I think our name and brand instill trust in every counterparty that we work with. And it's one of the reasons, we went into this market. A lot of the larger competitors have exited the lower and the core mid market. I think that's a mistake. And I think our goal is going to be to nurture this segment of the market so that we can do it. And we've got our first example, quite frankly, this month where, knock on wood, if it goes through, a business we brought in a little more than a year ago grew from mid-20s of EBITDA into 100+ million of EBITDA, and they're accessing the broadly syndicated loan market pretty successfully. This is a company that we expect to continue to grow, and they may be an IPO candidate. And the sponsor jokingly said, I can't wait for you to touch up the case study, and we want to be the first. So I think that's
very valuable for our franchise. I think it's very valuable to the customers that we're investing in, because we can say to them that we can grow with you no matter how large you are, and we can invest in you no matter how small you are.
So, Ariel, if we go up to the asset class for a second, and think about direct lending and how it might be perceived by a lot of participants as new, so a nascent asset class hasn't really been tested yet. There's a lot of money flowing into direct lending, and at the same time, we've seen rates go from 0 to 5% over a short period of time, which is good for returns. Again, going back to the floating rate nature of direct lending, but does exert stress on company balance sheets. So, in your opinion, is this cause for concern?
The beauty of direct lending, as you just mentioned, is that it's a really a floating rate product. So that, taking a step back, that base rate, in the US SOFR plus a coupon plus OID means that in times of rising base rates, as you're mentioning, going from 0 to 5%, that certainly benefits, direct lenders. And in times of declining base rates, actually direct lenders are protected as they've inserted floors to that base rate, which is typically around 1%. And so when we think about that base rate movement, if you look over just a short time horizon, yeah, the yield curve appears to be, at an all-time high. But if you actually look over a longer term horizon, yields are in a more normal range. We definitely believe this should be considered by investors in their overall asset allocation, as they consider, their balance between equity and fixed income and private credit. In our view, we think that investors in this environment should actually prefer to increase their yield exposure through alternative credit solutions, because we think it just provides them with better protection against volatility, allows them to profit from, the shorter end of the yield curve today.
David, what's your thinking on the market being tested?
I think the core and lower mid-market are time-tested strategies. I mean, these are strategies that existed in insurance companies, commercial finance businesses, and banks, 20, 30 years ago. I'm in Chicago. Our business is being built in Chicago. Heller Financial was mentioned a lot. GE Capital was here, Merrill Lynch Capital, et cetera. So these are businesses that all invested, in the lower mid-market and core. In my mind, the new is really the advent of the $1 billion unitranche, right? The first $1 billion unitranche occurred in 2019, and that market has grown pretty dramatically since. And with that growth has come an evolution to the traditional direct lending structure, which is a really tight covenanted document and structure. I don't think that has seen a serious test. A lot of people point to the pandemic. I think it was a pop quiz, quite frankly. It was quick, it was painful, but you had a very unique situation in that it was so dramatic and entire portfolios were impacted that the negotiation style was quick. I can do this, you can do that. Okay, we move on. I can't do anything. Okay, we move on. When you're in a typical dislocation, it's long. Right. And higher rates may test this, the 2021 vintage, because we're a little over a year into full SOFR impact, 5+%. And so when you have that amount of time, people can wait, they can be patient, right? Instead of having to react so quickly. So I don't think these will perform in a similar manner, but time will tell.
What about flows in terms of new money? What's your thinking there?
Well, there has been a lot of capital flowing into our businesses. A lot of it is, focused on the upper end of the market. I think that the one thought that I'd like to leave listeners is that we don't behave like liquid strategies. And what I mean by that, if you think about a high yield manager, they are investing versus an index, right? Every high yield manager has an index. They're investing versus it. They could be 90% of the index, 10% off, 20, 30% off, but they all move the same when it moves up or down. Your alpha is generated by how correct you were being off the index. I mentioned this earlier when I asked Ariel the question. Private credit direct lending is very bespoke. Each group, we don't compete with the same firms often. You see different groups in different regions. You could take the 3 or 4 largest direct lenders and compare their portfolios, and you would not have a ton of overlap. I think most people think there's a substantial amount of overlap, and everyone's very similar. So I think when you're looking to invest, you do the things that Ariel mentioned. Look at the team. Are they disciplined? Have they done this before? Will they have the discipline to say no? Right? Who are the firms? I talk a lot about the right to win. Who has a right to win? Right? It's you get a first look at an investment opportunity. If you're a little off, because again, there's no real market for this. This is 2-3 firms putting in what they think's the right structure. If you're a little off, do you get the last call? And do you have the ability to say no when the investment doesn't fit? And I think that even though a lot of money has come into the asset class, the firms that have that right to win and have that discipline, I think will be successful downside managers of risk.
Those that have been acquired by larger firms don't always have the ability to say no, even though they have the right. So they need assets to grow, justify the multiple that was just paid for them in many instances. So there is some lack of flexibility there sometimes, right?
I think so. I wouldn't want to be a smaller firm or a firm that lacks innovation. We just completed our fundraise, and quite frankly, it was humbling. We were ultimately successful, but my insights from the past year or so on the institutional trail is that these firms care about scale. They want access to a broader fund family. They want to know that you have systems that are scalable. They want to know that the right people are attracted to your platform. And if for some reason you have turnover, you can replace those folks with highly talented people. And if you think about who we are as a firm, all the folks we're working with, they didn't need another direct lender, so to speak, but they were super excited to work with us. They're excited because they knew Fidelity was one of the largest credit providers in the world. They knew Fidelity was one of the largest equity buyers in the world. And as a result, we're able to deliver that to our customers, and our customers are just starting to see the benefit of that. I think it's going to be an interesting couple of years in our marketplace for smaller firms and firms that lack innovation. And I'm pretty excited that we're bringing the direct lending market Fidelity at scale.
Ariel, I've heard you mention that in other conversations that capital deployment efficiency and lower costs are important things to consider in a manager. Can you explain that?
Sure. Chris, why don't we start with deployment? So, as we've kind of mentioned throughout this podcast, private credit is coupon based with limited to no equity upside. So as a result, if an LP commits, for example, $100 to a fund, and that fund only draws 60 or 70% over the next 3 years, the LP's opportunity cost on the remaining 30 to 40% is huge because they need to reserve that capital in case the GP does call it. So therefore, maximizing that deployed amount results in additional dollars earned for those LPs. And then when you think about costs, which is kind of another element, direct lending is a relatively plain vanilla product. So as a result, reducing your fees and increasing deployment really results in significantly more dollars earned for that LP.
So as an LP, your role is to make sure that you at least hit these thresholds, and then differentiation can come from managers that have a history of exceeding your deployment cost targets, among other criteria.
Yeah, I think that's well said. And then we can talk about diversification later on.
So as we wind down our conversation here, I'm speaking with two investors who are paid to be pessimistic and focused on the downside. So what will go wrong first? What are you worried about? And looking forward, how does your process increase the likelihood you'll be resilient or all weather? Ariel, let's start with you.
Sure. I mean, there are two things that really concern me, in this market. And the first, which I think everyone is talking about, is M&A. Over the past 18 months or so, the M&A environment has been very muted, which ultimately has a big impact on pricing and terms for lenders. So, for example, starting at the end of 2023 and continuing, well into 2024, we've seen significant contraction in pricing across the direct lending market. There's just too few good deals for the amount that lenders would like to deploy. So if M&A does not pick up, pricing will just continue to tighten and terms will also become looser, which does not benefit the lender. So, I would say, even with that said, lenders are still, over earning, in this market primarily as a result of the rise in base rates. But this will change if M&A doesn't pick up. And then, the second is to diversification, as you asked, before about rising base rates and how is that concerning. So from our perspective, diversification in private credit is very important, given, as we've talked about, there's no equity upside. So for example, a private debt GP cannot make up a loss like a private equity GP with a future home run. So as a result, having a diversified portfolio with, 1% or smaller position sizes means that no one loss can actually have an outsized impact on an LP's overall portfolio returns. So therefore, in an environment with relatively high base rates in the short term, higher inflation, diversification from our perspective is very important. And so that no one borrower, fumble can actually negatively impact a portfolio.
That makes sense. These issues are somewhat pervasive across private and public debt, as markets seem to be priced to perfection today. David, what are your thoughts?
Maybe to add something to what Ariel said on the M&A front, one of my bigger concerns is the health of private equity in the near term. I'm a big long-term private equity bull, but the credit markets are very healthy right now with an appetite, and we're still not seeing M&A volume. And so that tells me that not all companies are performing up to expectations. And when you think about the last 10, 15 years, it's really been up and to the right in our market as well as the private equity market. And normally when that occurs, there's a cleansing at some point, and that's natural. In our market, I think the worry for investors should be, did you partner with the right firm? Right? I think there are a lot of firms that we see that look more like an allocator to private credit than a lender or an investor. And normally when you have any type of disruption, those are the firms that will truly be tested to see if they were in fact an allocator, if they were an investor, if they had the team set up, to manage that stress, et cetera. When you think about the middle market, it's a credit by credit business. You need to avoid as many losers as possible, because your winners are all around the same coupon, and you only get your principal and your coupon back at the end of the day, right? Unless you get into private equity the wrong way through a restructuring or bankruptcy. Our process is pretty boring. We do the same thing on every deal. We call it a middle market process. We want access to the private equity firm. We want access to the management team of the company. We ask a lot of questions. We want to know what we're getting ourselves into, so that when a problem arises, because in a business of any scale in investing, you're not going to be perfect. You're going to have challenges. So when they arise, we at least have a good understanding of the business and the owners, and can hopefully, work through them. We're trying to underwrite businesses that have a real reason to exist. And as credit investors, we're trying to figure out, why that reason to exist could be challenged in the future, and just do that over and over again.
The process may be a bit boring, but I'm sure our listeners will agree this conversation has been anything but. Some truly insightful comments and perspectives from you both. We're going to go ahead and leave it there. I'd like to thank you, Ariel and David, for taking the time to join us. As you consider the fact that investments you're making pay you back the coupon, and getting your principal back with limited upside, but a high degree of downside risk, using discretion and discipline is critical to win in this market. You've both provided great depth and understanding in direct lending, both from a manager's and an investor's perspective. So to borrow another quote from a member of your team, David, yesterday is over. We need to get it right today. Certainly good advice we can all benefit from. This has been Alternative Angles. I'm Chris Pariseault, and thank you for listening.
Information provided in and presentation of this document are for informational and educational purposes only, and are not a recommendation to take any particular action, or any action at all, nor an offer or solicitation to buy or sell any securities or services presented. It is not investment advice. Fidelity does not provide legal or tax advice. Before making any investment decisions, you should consult with your own professional advisors and take into account all of the particular facts and circumstances of your individual situation. Fidelity and its representatives may have a conflict of interest in the products or services mentioned in these materials because they have a financial interest in them and receive compensation, directly or indirectly, in connection with the management, distribution, and/or services of these products or services, including Fidelity funds, certain third-party funds and products, and certain investment services. Information presented herein is not a recommendation or an offer or solicitation to buy or sell any security or digital asset. Views expressed are as of September 2024 and may change based on market and other conditions. Unless otherwise noted, the opinions provided are those of the speakers and not necessarily those of Fidelity Investments or its affiliates. Fidelity does not assume any duty to update any of the information. Some of this information is forward-looking and is subject to change. Past performance is no guarantee of future results. Investment results cannot be predicted or projected. S&P 500 Index is a market capitalization-weighted index of 500 common stocks chosen for market size, liquidity, and industry group representation to represent U.S. equity performance. The Bloomberg U.S. Aggregate Bond Index is a broad-based flagship benchmark that measures the investment-grade, U.S. dollar-denominated, fixed-rate taxable bond market. The index includes treasuries, government-related and corporate securities, mortgage-backed securities, agency fixed-rate pass-throughs, asset-backed securities, and collateralized mortgage-backed securities, agency and non-agency. The Cliffwater Direct Lending Index is an asset-weighted index of more than 11,000 directly originated middle-market loans. Fidelity Investments, Institutional Investor, and StepStone Group are not affiliated. Fidelity Investments provides investment products through Fidelity Distributors Company, LLC, and clearing, custody, or other brokerage services through National Financial Services, LLC, or Fidelity Brokerage Services, LLC. Members NYSE, SIPC.